watching Daybreak Asia, coming to you live from New York, Sydney and Hong Kong.
We're counting down to the opens in Tokyo and Seoul.
Australia has just come online. The top stories this hour. Traders are paring back bets on Fed rate cuts as Governor Chris Waller warns of a cautious approach, the dollar jumping the most in 10 months. Still, the prospect of a Fed pivot has big US banks calling a bottom on deal-making, the drought that's plagued earnings for the past 2 years. And China weighs further stimulus in the form of special bonds as Premier Li Qiang says the economy hit its 2023 growth target without adding risk.
Well, Heidi, I think you really just captured what's going to be the key market mover in the session today. That's the Fed Governor, Chris Waller. I won't get through too many details of what he said, but at a headline level, what he's calling for is a cautious, careful approach to cutting rates. And he only says that that can happen if the conditions are right. So they need to see price pressures continue to cool. They don't want to, of course, see inflation rebounding over the course of this year. So higher Treasury yields was the hallmark of the previous session. You've seen that reflected so far today, and a much firmer dollar. You said the highest or the biggest jump we've seen for the greenback in 10 months. The Aussie dollar down as much as 1.2% in the prior session. This morning you can see it here stabilising. Those two factors, when you put it together, it's a negative for equities, and we are seeing most futures pointing to the downside. The ASX 200, okay, it's a flat start here today, but staggered as well, so we'll see how it performs in about 10 minutes from now. Let's change on, because just take a look at what else is shaping up so far today. You've got the Aussie yen, or rather the Japanese yen, trading around its 100-day moving average. So currency weakness does continue to be present there, something that could actually end up boosting Japan stocks over the course of the day. When you do look at futures, they're really one of the few ones that's in the green. Kiwi stocks online to the downside, and you're also tracking what's happening in China today. You've got this Bloomberg scoop that we had, perhaps some plans for some special bond issuance, and also to note, we'll get the monthly activity data. We'll get the GDP reading as well for last year later, Shery.
Right, Belle, take a look at how U.S. futures are opening in the Asian session. Really muted after we saw the S&P 500 pressured, as Belle was telling us, really that Fed speak pushing against aggressive rate cut bets. But we also had earnings, of course, with big banks wrapping those up for the fourth quarter. And we had a little bit of a mixed picture where we had Goldman Sachs topping profit estimates, but Morgan Stanley disappointing, warning about margins in their wealth business. At the same time, we had oil right now opening to the downside, $72 a barrel right now for WTI. We already saw losses in the New York session, which were pared back a little bit because it's really cold here in the U.S. and that cold front really hampering some of that crude supply. But it was really to do with what was happening in the Treasury space. We saw the 10-year yield topping 4% on Christopher Waller's comments on that methodical and careful rate cuts. Take a listen to what exactly he said.
With economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past.
Well, in the meantime, Chinese Premier Li Qiang says the economy grew around 5.2% in 2023, surpassing the government's growth target for the year. He was speaking in Davos the day before the country unveils its official growth numbers.
Chinese economy can handle ups and downs in its performance. The overall trend of long-term growth will not change.
Let's bring our China economy editor, Diesa, joining us now for more. And, typically that GDP number is the less interesting in terms of what you want to see when you lift the hood with China's numbers. But does what we heard from Premier Li Qiang tell us about the kind of balancing act that Beijing wants to strike in terms of maintaining a reasonable level of growth without adding too much more debt and risk?
Yes, well, I think the first thing to really consider here is the fact that we saw Li Qiang front-run this number about a day ahead of the official announcement. A bit unusual there, but maybe just projecting some confidence in the trajectory of the Chinese economy, or at the very least projecting some confidence in how exactly they're going to, obviously have hit their growth target and then what they're going to set up for 2024. I do think it's important, though, to, yes, you're right, to note that he did say that that was without any kind of massive stimulus. I think that the Beijing wants to sort of underscore here that they don't want to pump tons and tons of cash into the economy to kind of get things going and help activity. I do think, as we get those numbers a little bit later, this morning, we have to consider the fact that, the fourth quarter, kind of a low bar to hit. It compares to a 2022 when we were dealing with quite a lot of COVID restrictions, outbreaks of still with the pandemic. So low base of comparison there. But ultimately, yes, I think it's really about that balancing act. How much stimulus are they actually going to pump into the economy this year? Are they going to cut rates? Are they going to, address reserve ratios? Are they going to up fiscal policy? I think at this point, he's kind of saying there, we do want to be measured in our approach in 2024.
And yet at the same time, Bloomberg has learned, Jill, that China is in fact considering more stimulus of the likes of $139 billion of special bonds. So how significant is this, and could this risk that leverage and debt issues that the country has already faced for years?
Yes, so I actually think, really important to dig a bit deeper behind these numbers that we're reporting. So yes, ultimately still considering this idea of some new special sovereign debt issuance. It's really not about the number. It's really more about the philosophy shift behind this idea here. I'm going to say just right out, this is not a massive amount of stimulus. So Li Chang, we're kind of holding to what he's already telling us here, this idea that this wouldn't be a massive support measure in dollar terms if they roll it out. But I think, again, remember, this is special sovereign debt from the central government. There's a lot of, obviously, some widespread concerns here in China about the fact that local governments are taking on massive amount of debt risks, or have been over the past decade or so. And there's this sort of sea change that we've been exploring here over the past year, where the idea is to shift more of that debt burden to the central government off of those really heavily indebted local governments. I think this would be sort of a step in that direction. So not a massive amount when it comes to the actual dollar, or rather yuan figure here, but really more of that shift in terms of who's got the spending responsibility here, trying to create a more sustainable debt model for this economy.
Our China economy editor Jill Deesa's there. Here in the U.S., big banks have been wrapping up their fourth quarter earnings this week. In the latest session, Goldman Sachs beating profit estimates and seeing revenue from its stock trading unit surge. Morgan Stanley also blew away estimates, but its outlook disappointed. Bloomberg's Sue Keenan joins us now with more. And Sue, we saw the reaction in their respective stocks, and Goldman actually gaining ground.
Yeah, for Goldman, it was a year of transition. Really blew away expectations, particularly from its equity trading desk, where revenue was triple what was expected. The asset and wealth division also helped drive gains, posting its highest quarterly revenue in 2 years on a gain tied to the sale of a financial management business. So you can see between Goldman and Morgan Stanley, really a tale of two different stock performance, which we'll get to in just a minute. But in any event, the Goldman wins helped counter a few weak spots. Goldman's fixed income trading results and investment banking fees fell short of expectations. Now, CEO David Solomon said, quote, "This was a year of execution, I should say, for Goldman Sachs on expectations, and with everything that they achieved in 2023, he says, coupled with their clear and simplified strategy, they have a much stronger platform for 2024. Analysts called the results decent, relatively solid, with Evercore's analyst Glenn Schorr saying Goldman's results were, quote, not as bad a quarter as feared. Again, a lot of these analysts are aware of the difficulty that these banks experienced. Goldman CEO in particular under pressure. In any event, Goldman more reliant than other banks on deal making, which has remained depressed.
Meanwhile, Morgan Stanley warning of lower margins when it comes to the wealth unit.
Yeah, and this really resulted in a bit of a skeptical reception, if you can call it that, for the new CEO, Ted Pick, who officially takes over this month, helming the ship after James Gorman moves on. His first order of business was the earnings call and having to really warn about lower margins in the wealth unit, which has been an area of strength. Investors now turning their attention to the firm's ability to meet its goals in expanding its wealth business. Shares dropped the most in 3 months. In fact, the most since their last earnings call, down as much as 4.3% at one point. Again, the fixed income trading fell short of expectations, and executives said that the lower wealth margins will be sticking around for a bit. Pick said, quote, the wealth business is actually in my blood. He said this will be the engine for Morgan Stanley going forward. Net revenue for the wealth unit totaled $6.65 billion, beating earning. But again, they're warning that the business has been aided by higher rates, but it will be challenged a bit on margins going forward.
Bloomberg Sue Keenan there with the latest. Coming up next, Ukrainian President Vladimir Zelensky meeting with business leaders in Davos, trying to attract private capital. We have the details later this hour. But first, Fire Trail Investments sharing their market outlook on why they see geopolitical turbulence becoming a constant concern this year. This is Bloomberg.
The resilience of not just the economies but also financial markets to the geopolitical crises that are going on, to the rise in interest rates and the fight against inflation has been remarkably strong.
There is some wind coming from 23 into 24.
The overall sentiment for 2024 is positive.
We are going into a soft landing.
U.S. poised for soft landing.
Expect very probably a rate cut this year.
We don't think the rates will probably come back down to the levels we saw pre-COVID or pre this interest rate cycle, just because of the level of government debt and spending and the state of the economies across the world.
We're in a tight fiscal space at the moment, both as a result of the global challenges and domestic challenges.
The risk of this thing going the wrong way is there and will continue to be there into the foreseeable future.
Expect the unexpected.
Some global policymakers, business chiefs really giving us their assessment as we get into 2024 there at Davos. Our next guest says geopolitical turbulence is now a constant concern, even in optimistic economic environments. Anthony Doyle is the head of investment strategy at Fire Trail Investments and joins us here in Sydney. Anthony, Happy New Year. Great to have you with us. And it's an interesting kind of dynamic that we're working with, right? On the one hand, we could stick a soft landing. It could be that kind of Goldilocks scenario. Do you think the geopolitics of it and the risk that is building as we get into this key election year for so many economies is going to outweigh that?
Yeah, it's certainly seen very rapid shifts in sentiment within markets and risk markets, particularly over the course of the last 6 months. And much has depended upon the outlook and evolution of inflation, the outlook for interest rates and Federal Reserve policy and central banks around the world. And of course, this year fraught with elections and geopolitical events stemming from the Middle East to the US and beyond. And you can see how quickly sentiment can shift even overnight with some more dovish sentiment from central bank speak, and you start to see interest rate hikes, interest rate cuts start to be pulled out of the market. So it is something that investors from that top-down perspective will have to be highly cognizant of and factor into their assessments over the course of the coming 12 months.
Even with the Fed uncertainty that, moves a little, as you say, with each kind of, bit of Fed speak, you still see the most compelling opportunities in North America. Is this a year of breadth beyond the Mag 7?
Yeah, I mean, we are more optimistic on the outlook for the US economy than I would suggest the consensus is today. And that reflects falling inflation, rising real incomes, and the health of the US consumer and the health of the US labour market. But we do think the most exceptional opportunities in North America reside outside of the Mag 7. So we are expecting breadth to widen out into the market, and in particular the mid-cap part of the US equity market, and looking beyond even the S&P 500 to say the Russell 2000 for opportunities to deliver alpha over, say, the coming 3 years or so.
Outside of the US, what are you liking, particularly here in Asia?
So we have exposure to Taiwan Semiconductor, and obviously we've just gone through the elections there, and it's really a continuation of the status quo with, again, geopolitics and that risk weighing on the valuation of TSMC, and so we continue to like TSMC. In India, we own HDFC, so India's largest private bank, 25 million customers, really a blue chip company within the Indian Stock Exchange. But generally, we are actually more overweight Europe and an underweight Asia, really on a valuation, from a valuation perspective. That's where we're seeing the most exceptional opportunities.
We haven't spoken about two markets that I do need to ask you about. Japan, do you think it's a little bit overdone?
I mean, it has been extraordinary. We do expect that the yield curve control and negative interest rates, we'll probably see the end of negative interest rates towards around April from the BOJ. But it has been the consensus trade, really, over the course of the last 12 months. Last 12, 13 months has been a weaker yen and a rise in topics. It is a market that we're scouring, that we're looking for. We haven't found the right opportunity to invest in yet. It is 7% of the MSCI World Index, but we do think that, again, today, where we sit in terms of markets, it is an environment where it's all about that bottom-up stock selection rather than getting that beta exposure to indices. So we'll be more favoured of looking for exceptional opportunities rather than buying the topics as a whole.
Yeah, that's a consensus trade. Contrarian would be if you were to be constructive on China.
Absolutely.
And you talked about, compelling valuations. What do you think? I mean, is there anything that would compel you to take some risk there?
It's almost max bearishness on China at the moment. And if you are looking at China, it is getting closer and closer from a valuation perspective to potentially being an allocation within a global equity fund, I would suggest. We're not there yet.
What would be a catalyst?
I think that if we did start to see significant stimulus coming into the economy, but there is still that overhang of debt build-up, concerns around the property sector, concerns around consumers building up savings. You really need to start to begin to see some of those overhangs start to be alleviated, potentially see central bank action. That would potentially see, I would say, foreign direct investment start to flow back to the Chinese stock market.
It's a pretty high bar, the way that you've just described it. Anthony, always great to have you with us. Anthony Doyle, Head of Investment Strategy at Hak-Cheol Investments here in Sydney. More to come on Daybreak Asia. This is Bloomberg.
We're so happy.
Morgan Chase. God bless you.
Thank you so much.
How are you? Fine, thank you. Great to see you. Good to see you.
We're looking at Ukrainian President Volodymyr Zelensky meeting with business leaders at Davos. Zelensky is seeking to attract private capital with billions of dollars in aid for Ukraine currently stalled in Washington and Brussels. Bloomberg's Anne-Marie Hordern has more.
Geopolitical risks and the potential for another Trump administration are dominating the conversations here at the World Economic Forum in Davos. First to the geopolitics. President Zelensky was here meeting with business leaders like JP Morgan's Jamie Dimon and Ray Dalio. This, of course, comes as Kyiv is trying to rebuild their battered economy. He also sat with Secretary of State Antony Blinken and National Security Advisor for President Biden, Jake Sullivan. This is as aid talks continue to remain at a standstill in Washington, D.C. Kyiv is, of course, looking for $100 billion in aid from both Washington and Brussels. And when it comes to Washington, the potential for Trump 2.0 has everyone wondering what would that mean for their economy, especially Europeans. This started on Friday when ECB President Christine Lagarde said another Trump president would be a, quote, threat. And that's not going away anytime soon, as Iowa voters last night gave him a commanding lead. I'm Anne-Marie Hordern in Davos, Switzerland for Bloomberg.
Some of the other geopolitical stories that we're following today. Another commercial ship has reportedly been hit by a missile in the Red Sea. This is the second in 24 hours. Ambry Analytics say a Greek-owned bulk carrier was hit about 122 kilometres northwest of Al Salif in Yemen. Meanwhile, the US says its forces destroyed 4 Houthi anti-ship ballistic missiles in drone strikes on Tuesday. And Shell reportedly says it's halting oil tanker transits through the Red Sea. Some ship insurers are starting to avoid covering US and UK merchant ships against war risk in the Red Sea. Professional services firm Marsh says underwriters are seeking exclusions for such vessels when issuing cover for trips through the waterway. War risk rates have gone up in recent days as Houthi militants continue their attacks on ships despite these airstrikes by the US and UK. Well, Chevron CEO Mike Wirth says the firm still plans to ship cargo via the Red Sea. Speaking with Bloomberg in Davos, he says Chevron is working with naval authorities in the US and the Middle East.
We engage with the U.S. Navy and other security organizations for all of our movements to the Arabian Gulf, the Red Sea, and on every voyage we have a security plan, and it's really ship by ship that we evaluate the situation. So we're working very closely with the maritime security authorities. The risks in the region have been accelerating over the last several weeks. These are risks we deal with all the time. Last year we had a couple of ships attacked by the Iranian Navy. Actually, one of them was boarded and hijacked into an Iranian port. So this is a part of our business that we deal with. We take it very seriously. The safety of our people is the most important thing, and the risks in that part of the world are very dynamic and volatile right now.
Have you made any changes in the last few weeks?
We've made changes that we don't talk about publicly in terms of the security protocols. We have not made fundamental changes to how we've been moving ships over the last few weeks.
Are you surprised that we haven't seen any influence on prices whatsoever?
I actually am. That's an important part of the world for oil supply, and traditionally when risks elevate in the Middle East, you see it reflected in markets. We've not really seen that yet. And so I'm a little surprised.
So what do you think it would take? I mean, do you think that the excuse that people use, which is that the U.S. is just overwhelming the world with oil, and that's the reason why oil prices have remained completely immune to any tensions in the Middle East, do you buy that story?
Well, certainly U.S. supply growth has surprised people to the upside, and I think it has helped calm markets a little bit. But it certainly has no ability to cover up a big disruption in the Middle East. That will fundamentally change the supply dynamics in the world if you were to see shipping halted, disrupted, or seriously disturbed. And so I do think that the U.S. supply has helped kind of calm markets over the longer cycle, but there's no capacity to respond in the short term to an interruption like that.
13 million barrels a day. Can we just sort of frame this just for a moment? How much potential is left? How much higher can that number go?
It can go higher. The U.S. is blessed with an abundant resource base. The constraints tend to be, right now, the capital spending of suppliers, how fast suppliers will go. A decade ago, companies in our industry were growing too fast in the Permian Basin in particular, and investors were unhappy with that. I think we've seen companies throttle back capital spending, return cash to shareholders more consistently. If they were to return to the ways of the past, I think you could see that number go higher. I don't see that going on right now, but the U.S. has upside.
Well, but this is the reason why people are wondering about the potential disruption. And I'd love it if you could quantify where we could see prices go if some of the disruptions that you're talking about come to pass, if the U.S. still has the ability to produce more oil, right? If there is the ability to ratchet it back up, couldn't that offset the disruption that potentially could happen that we haven't seen yet?
It could, Lisa, but not immediately. So between the time we actually have all of our plans ready to drill a well in the Permian Basin and when it comes on production, fastest is like 9 months. And our plans are set for years in advance. I mean, we've got it's a big system that you run to do this.
Last year, in 2023, the Chinese economy rebounded and moved upward, with an estimated growth of around 5.2%, higher than the around 5% target set at the beginning of last year. In promoting economic development, we did not resort to massive stimulus. We did not seek short-term growth while accumulating long-term risks.
Chinese Premier Li Qiang speaking there in Davos has discussed China's growth trajectory, not to mention the geopolitical challenges ahead, with Scott Kennedy, Senior Advisor and Trustee Chair in Chinese Business and Economics at CSIS. Scott, always great to see you. How would you say the speech by Li Qiang, as well as the reception from the audience at this Davos, actually compares to past performances by Chinese leaders?
Well, the only other real comparison that needs to be made is with Xi Jinping's speech at Davos in January of 2017. And what a difference 7 years makes. When Xi was there 7 years ago, he took Davos by storm through a very forward-leaning speech suggesting China could provide public goods for the rest of the world and be an important steward of the global economy. He highlighted the Belt and Road, contrasted China's growing openness with the U.S., which was in the midst of inaugurating Donald Trump. 7 years later, Li Qiang was much more defensive. He had to say that the world could trust China, that China keeps its word, and that China's market is not a risk but an opportunity. And he didn't mention the Belt and Road at all. So despite sending a very large delegation and making news by announcing the 5.2% growth rate for 2023, my guess is that the audience still came away rather skeptical of the message that Li Qiang was trying to convey.
And one of the key points that he made sure to mention was the fact that China wasn't using any more risky or short-term measures in order to prop up the economy. But at the same time, Bloomberg is now learning that they want to also have more stimulus for the economy, more than $100 billion of special bonds. How does that compare to real action on the ground?
Yeah, actually, I think I understand why he didn't want to emphasize the stimulus, because he didn't want to suggest that the Chinese had made any kinds of mistakes. Committing mistakes is just not part of being a CCP official these days. On the other hand, I think actually if he had said, we're going to have a larger stimulus, that would have been actually reassuring. I think if he had said, here's a date for the third plenum, where we'll announce a whole variety of reforms, that would have been reassuring. If he had announced plans, real policies for cross-border data flows and government procurement, rather than saying that plans were coming, that would have been reassuring. So there could have been a whole variety of things that he could have said that would have been reassuring to that audience that he left off the table.
Scott, as you say, it may have been underwhelming for the audience, and I have to say you sound a little underwhelmed as well. Do you think that the domestic challenges, the economic challenges, the fact that we know that there are yet more purges and corruption campaigns underway as well, is that really hindering, at the end of the day, Beijing's ability to take that global leadership role, which was so trumpeted by Xi in his Davos speech, right?
Yeah, I mean, it's partly that there's these domestic challenges. You've got these corruption cases, challenges with the military, former Minister of Foreign Affairs to handle. But Xi Jinping is just, it comes down to him and the direction that he's taken China. If you go back to the speech of January 2017, he said he wanted China to be a steward of the multilateralism and provide global public goods. And given the amount of industrial policy we've seen, the frictions with the United States, which is caused both by Beijing and Washington, it just doesn't look that way. Today, Li Qiang did not mention Ukraine at all. There was a meeting at Davos that the Ukrainians hosted, which the Chinese skipped. There was no mention today about the Taiwan Strait, which is one of the biggest things that CEOs are worried about. He could have tried to provide reassurance about that. So I think there's a direction that China is going, which is just running counter to the concerns of global business people, and most importantly, to the Chinese private sector, which is the biggest source of employment and growth in China.
The other thing that we've been watching is this idea of high quality growth, right, which feeds into a lot of the themes that we've just touched on. But at the core of this new growth strategy are things like electric vehicles, battery technology, AI technology, chips. Is all of this just going to feed into inevitably, even more heightened tensions with global trading partners, particularly as we go into a US election year?
Sure. I think as long as Bloomberg has been reporting on China through this program, Chinese officials have been talking about the importance of high quality growth. That's been a constant, right? For decades, they've been emphasizing that. But now the question is that high quality growth going to be something that is shared with the rest of the world, or is it going to divide the world between Chinese winners and losers elsewhere? And so I think there's a real concern that Chinese industrial policy, while it is generating high value growth for China, might be putting the auto sectors or energy industries elsewhere at risk. And so we've got to figure out a way that Chinese economic policy is growth creating for everyone in the region and in the U.S. I do think that there's a good argument to be made for that. But sitting in Washington, I can't tell you the level of skepticism that I encounter here. And we're going to hear about it all 2024 during the presidential campaign.
Scott, and of course, in the past few weeks, we've been really focused on what was happening in Taiwan with the elections there. It was really interesting that this week, China actually decided to publish that old speech by President Xi Jinping telling officials in the Communist Party to do a better job at winning the hearts of the Taiwanese people, given the election of Lai Ching-te. How do you expect the tensions in the Taiwan Strait to play out in the next few years? And what are the risks and implications for the economies of these two territories?
Sure. Well, I mean, China can't give up the goal of unification for sure, and it can't renounce that it will never use force. But its strategy of the past few years in the run-up to all of these elections obviously hasn't worked. Taiwanese voters haven't followed the instructions from Beijing. And China's military capabilities are quite impressive, but there's a balance of power because of the United States and the rest of the world paying attention. So they've got to go back to a different playbook. And I guess he's partly pulling that out and saying, you know, for the next few months, we've also got to figure out how to try and stabilize things. Also, you can't play all your tough cards just at the election outcome. There's still several months before the inauguration, and there's much more to do. So it's going to be dicey. I do think that the U.S. And China are talking a lot about Taiwan and trying to avoid a crisis. So I think there'll be a lot of heartburn, but I also think that there's a way to navigate through this so that the world's global economy and a conflict doesn't emerge, because it really is unnecessary.
Scott, always great to chat with you. Scott Kennedy, Senior Advisor at CSIS there. Well, South Korean battery giant LG Chem says it's hopeful about a progressive demand recovery in China. That says they see a grey outlook for the petrochemical sector this year. Its CEO, Hak-Cheol, spoke exclusively with Bloomberg in Davos.
It's quite well known that petrochemical is going through some kind of challenging time right now. If you look at the global capacity exceeding the global demand, and global demand is not coming back as strong as we might have expected, especially after COVID, especially from Asia, and particularly the Chinese demand is not coming back as strong as we expected at a time when global capacity continued to expand. So there's a little bit of imbalance between global supply and demand, which causes some temporary trouble, which we have seen before. So I'm not overly worried about it, but if you ask me what's the prospect of petrochemical, I think it's generally gray this year, maybe throughout the first part of next year.
When do you see China's recovery coming back and hence, boosting demand for petrochemicals? Yeah,
we hope as soon as possible. I'll keep my fingers crossed.
Would 2024 be the year?
Well, I think Chinese New Year, or Chunjie, is coming up. Hopefully, that one, and maybe some more events in China, which will trigger people to spend more money, basically. It's not a lack of money. People have money there, but they don't spend as much as they used to because they're worried about lots of things. Real estate bubble, they're worried about general economy, they're worrying about war, inflation. So I think generally speaking, Chinese domestic economy is big enough to sustain its own domestic cycle, but I hope Chinese people can spend a lot more money this year and next year. So I think the prospect is not any steep recovery in demand in China, but it will be slow recovery. But it is quite certain that it will be better going forward in China in terms of demand.
LG Chem CEO Hak-Cheol with Bloomberg's Hassan Daamin in Davos. And we're seeing early reaction across Asia when it comes to the Fed Governor Christopher Waller's comments pushing back on those aggressive rate cut bets. Belle, what are you seeing?
Yeah, that's right. It's really the sort of key theme that's driving the direction for markets today when you cast your eye across the different asset classes. So let's just kick off with what we're seeing in the bond space here, because it is that move higher for Treasury yields. A little bit more by the longer end of the curve, which is in line with what we had in Treasury moves in the prior session. But as you said, it is the Fed Governor, Chris Waller, and he sort of downplayed perhaps the need to rush cuts and said that they do really want to see price pressures contained, inflation coming back under control before we start to see any sort of reduction. So it could be later in the year. So traders really repricing or recalibrating their expectations at least around the upcoming meeting in March. So lower odds now for a cut. Let's change on, see how that's playing out, because the moves in treasuries that led to a stronger dollar, that's really played on the Aussie currency as well. And that's a negative, as we know, for stocks generally, and Aussie ones a little bit weaker so far in the session, 40 minutes into trading. What's moving the most to the downside so far is what we're seeing in the energy sector here. That sub-index down around 0.8% at this point in time. Let's change on, because it does really reflect the moves that we've seen in oil prices as well. So WTI, it's lower for a second straight session this morning. Given the risk of tone coming through in markets, you've got these energy or oil-linked names also leading the losses so far in the session. It's interesting as well, because actually the downbeat mood did, and the stronger dollar did really outweigh some better factors, like we're seeing reduced supply in the US. And Red Sea tensions do persist, and that's something that could, Heidi, of course, lead to higher oil prices over the longer term.
Belle there in Hong Kong with some of the elements that we're watching as we get into this midweek trading session. You can watch us live and catch up on past interviews in our interactive TV function. That's at TV Go. You can dive into any of the securities or the Bloomberg functions we talk about, joining the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
Welcome back. We're 15 minutes away from the open of markets in Japan. The head of Nomura's investment banking unit saying the Bank of Japan is likely to move away from its negative interest rate policy as soon as April. But Christopher Wilcox also telling us that investors betting on rate cuts from other major central banks this year may be disappointed.
I think that the main themes obviously are inflation and monetary policy still. We've had a year of inflation fighting from the central banks, and they seem to have got that under control, and we've had a disinflationary move for the last few months. That's led, I think, to a broad consensus of a soft landing across the US and in the developed markets. And I think, clients broadly are going to be focused on whether that comes to pass or not. Our view on that is a little more cautious. We think that central banks are going to remain vigilant for longer. I think that they were shocked by this inflation move, and I think they're going to make sure that it's under control before they move forward. So our view on the market is perhaps that interest rate cuts come a little bit later, and that there are probably fewer of them in 2024.
The one bank that stands out, Christopher, good evening, it's Guy, is obviously the BOJ. We're all waiting to see what happens in 2024. You're quite well placed to give us a view on what you guys are anticipating, and were we to see a move, what impact would it have on you?
So the BOJ, obviously, a lot of people have been watching their extremely accommodative policy. There's been a lot of narrative this year that they wouldn't be able to stick to it, and yet they broadly have. We think that actually our views changed somewhat and moderated because growth in Japan seems to be reasonably strong, and we do expect that to continue. And markets in Japan obviously have been very strong in the last year, which has obviously been great for our business and our clients. We think that it's quite possible that we see them move away from the negative interest rate policy that they've had sometime in the first half of this year, possibly as soon as April, and also perhaps move away from yield curve control as well. Having said that, we don't expect them to then go into a hiking cycle anytime soon. I think they're really determined to get a virtuous circle going between wages and prices.
Nomura's investment banking head Christopher Wilcox there speaking to Bloomberg from Davos. Let's take a look at some of the other corporate stories that we're following. And Spirit Airlines shares lost almost half their value after a US federal judge blocked JetBlue's $3.8 billion takeover. The court ruled the combination would stifle competition. The ruling follows a trial in November where government lawyers argued that the merger would eliminate a key incentive for bigger airlines to offer budget-friendly fares. Uniqlo is suing Shein, accusing the Chinese fast fashion retailer of copying its popular round mini shoulder bag. Uniqlo parent Fast Retailing says Shein operators must immediately cease sales of imitation products and compensate for damages. It's the latest established retailer to sue Shein following rival H&M's lawsuit in Hong Kong last year over alleged copyright infringement. BP is reportedly close to naming its acting CEO, Murray Auchincloss, as the permanent successor to Bernard Looney. Sky News says an announcement could come by Wednesday. Auchincloss was named interim CEO in September after Looney resigned for failing to fully disclose past relationships with colleagues. Coming up next, Sam Altman talks to us about the future of AI and why it may not be the job killer that many people fear. Our discussion from Davos is coming up in just a moment. This is Bloomberg.
AI is a brilliant tool for people to be more productive. Now, it means the bad guys will be more productive, so they can do more cyber attacks, so they can design weapons. You've got to make sure the best AI for cyber defense or measures to defend against bioterrorism are in the hand of the good guys. And it's a challenge, but people sometimes lose sight of the fact that this is the biggest productivity advance in our lifetimes.
Bill Gates there speaking about artificial intelligence at Davos. OpenAI CEO Sam Altman says he doesn't think AI will replace human jobs to the degree that some people are expecting. Speaking to us in Davos, Altman also weighed in on the U.S. presidential election campaign.
I think there's a lot at stake at this election. I think elections are, huge deals. I believe that America is going to be fine, no matter what happens in this election. I believe that AI is going to be fine, no matter what happens in this election. And we will have to work very hard to make it so. But this is not, no one wants to sit up here and hear me rant about politics, so I'm going to stop after this, I promise. But I think there has been a real failure to sort of learn lessons about what's kind of working for the citizens of America and what's not.
There are political figures in the U.S. and around the world, like Donald Trump, who have successfully tapped into a feeling of dislocation, anger of the working class, the feeling of exacerbating inequality or technology leaving people behind. Is there the danger that AI furthers those trends?
Yes, for sure. I think that's something to think about. But one of the things that surprised us very pleasantly on the upside, because when you start building a technology, you start doing research, you kind of say, well, we'll follow where the science leads us, and then when you put a product, you'll say this is going to co-evolve with society, and we'll follow where users lead us. But it's not. You get to steer it, but only somewhat. There's some which is just this is what the technology can do, this is how people want to use it, and this is what it's capable of. And this has been much more of a tool than I think we expected. It is not yet, and again, in the future it'll get better, but it's not yet replacing jobs in the way, or to the degree that people thought it was going to. It is this incredible tool for productivity. And you can see people magnifying what they can do by a factor of 2 or 5, or in some way that doesn't even talk to it. Makes sense to talk about a number because they just couldn't do the things at all before. And that is, I think, quite exciting. This new vision of the future that we didn't really see when we started. We kind of didn't know how it was going to go, and very thankful the technology did go in this direction. But where this is a tool that magnifies what humans do, lets people do their jobs better, lets the AI do parts of jobs, and of course jobs will change, and of course some jobs will totally go away. But the human drives are so strong, and the sort of way that society works is so strong, that I think, and I can't believe I'm saying this because it would have sounded like an ungrammatical sentence to me at some point, but I think AGI will get developed in the reasonably close-ish future, and it'll change the world much less than we all think. It'll change jobs much less than we all think. And again, that sounds, I may be wrong again now, but that wouldn't have even compiled for me as a sentence at some point, given my conception then of how AGI was going to go.
As you've watched the technology develop, have you both changed your views on how significant the job dislocation and disruption will be as AGI comes into focus?
You know, you hear a coder say, okay, I'm like 2 times more productive, 3 times more productive, whatever, than they used to be, and I can never code again without this tool. You mostly hear that from the younger ones, but it turns out, and I think this will be true for a lot of industries, the world just needs a lot more code than we have people to write right now. And so it's not like we run out of demand, it's that people can just do more. Expectations go up, but ability goes up too.
OpenAI CEO Sam Altman there speaking at a Bloomberg House panel in Davos. Speaking of AI, and Australia's government will consider introducing mandatory guardrails on the development of the technology in what it calls high-risk settings. It's planning to establish a panel of experts to weigh options for restrictions on AI. An earlier review found that voluntary restrictions on AI development were insufficient, with potential inaccuracies, biases, and a lack of transparency. Well, we are counting down to the start of trading. Coming up next, the market opens in Seoul and Tokyo are next. This is Bloomberg.
This is Daybreak Asia. We're counting down to Asia's major market opens as we are now seeing some early reaction across Asia right now when it comes to that pushback again from a Fed official on aggressive rate cut bets. The 10-year Treasury yield topped 4%.
Yeah, some risk aversion on account of developing geopolitics, of course, when it comes to oil markets and shipping risk as well. But of course, some risk coming from the data dump we're expecting out of China today. We know what that GDP number is likely to look at. We know really, in fact, what to expect thanks to Premier Li Qiang speaking at Davos. But we are looking ahead to how those domestic activity indicators play out, whether that stabilization of the slowdown is seen. Let's get you straight to the market opens. Belle.
Thanks, Heidi. Shery, yeah, we've got the open here of Japan, Korea as well. At the start of the day, that focus, as you said, Shery, it really comes down to what we heard from the Fed Governor, Chris Waller, overnight. As you said, it's about being careful. It's about being methodical when it comes to cutting rates over the course of this year. Waller says that he really does not want to see resurgent inflation. That would be something, of course, that would keep rates higher for longer, and as well appearing sort of to just push back on these expectations in markets that we were going to be seeing 6 cuts over the course of this year. So that really played into the direction of treasuries, as you said, and we saw those higher yields coming through, still holding above 4% this morning as we come online, and we have seen bond yields moving higher across the Asian session so far today. When you do have that direction for treasuries, a firmer dollar, that also plays into the dynamics of the Japanese yen, of course, and that weakness that we've seen in the currency around its 100-day moving average at this point is one of the reasons that Japanese equities have been performing. You've got the Nikkei here standing out 0.8% to the upside, even though we're expecting most markets in Asia to trade lower in the session today. And that really is the focus of today's big take as well. The market dynamics, why, how we're seeing Japanese markets really just roaring back to life here, because these indexes trading around 34-year highs. So I have more details on that big take ahead. Let's take a look at what's happening in Korea so far in the session. Again, that focus very much coming down to the moves that we see in a firmer dollar, or the reaction to that. It plays into what we see for the Korean won here, because we are having that weakness coming through. It's already around the 2-month low of the currency. Emerging market assets generally have been under pressure given these doubts around the outlook for the Fed's rate cut path. And yesterday, we actually saw the emerging market stock index falling the most since August. Again, it's that move that we see in the dollar and also in Treasury. So far, though, the Kospi trading fairly range-bound. The Aussie session, meanwhile, really being dominated by some of the energy moves so far, and we do see energy stocks that are under pressure, linked very much to that move there that you're seeing for WTI, lower for a second straight session. It's that demand and dynamic that's really playing into it, that risk of sentiment, because, again, a firmer dollar does pressure commodity prices, even though we do see supply constraints building in the US. There's Red Sea tensions. And then as well, Heidi, you've got the outlook for China's economy and the demand that we're going to be seeing from oil, or for oil, from there this coming year.
Yeah, and a lot of those numbers will give us a better idea as to how that recovery is shaping up. And the Chinese Premier Li Qiang says the economy grew at around 5.2% in 2023, surpassing the government's growth target for the year. He was speaking in Davos a day before the country unveils its official growth numbers.
Last year, in 2023, the Chinese economy rebounded and moved upward, with an estimated growth of around 5.2%, higher than the around 5% target set at the beginning of last year. In promoting economic development, we did not resort to massive stimulus. We did not seek short-term growth while accumulating long-term risks.
Let's bring our China economy editor, Jill Diesa, for more. And Jill, perhaps less interesting was what he had to say, and more about the fact that he said it at all, right? Was this part of kind of a broader confidence-building exercise for international investors and partners?
Yes, certainly, Heidi. So this is pretty unusual that he would kind of front-run these GDP numbers here at Davos. Obviously, we're going to be getting more of that data today, more comprehensive data, looking at how industrial production performed through the end of the year, fixed asset investment. We'll also look at retail sales, unemployment, get some population numbers, tons of stuff that we're expecting out of China in just a couple of hours here. But yes, I think the fact that you saw Li Qiang talk about the fact that they've apparently surpassed their about 5% GDP target for 2023 indicates this idea that they're confident in at least how the economy performed last year. I think the question is what is going to happen this year. Maybe he gave a little hint there that they're still obviously very focused on risk control and this idea that they don't need massive amounts of stimulus, massive amounts of government spending to actually keep things in check. We'll see how much that actually plays into the calculus of how they form both fiscal and monetary policy for this year.
And Bloomberg has learned that China is actually considering more special bonds, more than $100 billion of them, and it's a very rare sale of such bonds.
Yes. So we were reporting that the government is considering issuing this additional sovereign debt. This is special sovereign debt. So, tradition has it that this wouldn't normally be counted toward the budget deficit for the year. We'll see if that's actually the case, as details continue to firm up. I do think that, in keeping in line with what Li Qiang said about not using massive stimulus to support the economy, that's true in the sense that this type of issuance would be fairly small numbers-wise. I mean, about $140 billion. That's not massive amounts of stimulus. But what I do think it tells you is it kind of feeds into this idea we've been seeing over the last year in China that there's a bit of a sea change in terms of how they actually, sort of allocate these spending responsibilities. As we know, for the past many years, there's been a massive amount of debt buildup among local governments in China that's become a very unsustainable model in China. And this idea would be to shift some of that spending responsibility, that spending burden from these local debt-ridden governments to the central government. We saw that a bit with a mid-year budget revision that involved issuing some sovereign debt in October of last year. This type of plan would take that to another level.
Our China economy editor Jill Diesa is there. Let's actually bring in our next guest who says China's policymakers are becoming increasingly focused on risks to the growth outlook. With us now is Mark Franklin, Senior Portfolio Manager of Manulife Investment Management. Great to have you with us. So does this mean that we're actually see more confidence in the Chinese economy? I mean, we saw Li Chang's speech at Davos, and now we have news that potentially we could see more special bonds. What does this actually mean for the Chinese economy in 2024?
Good morning. We're already starting to see a pickup in cyclical indicators, whether that's credit growth, bank loan growth, rail freight volume growth, and so on. So there are modest signs of cyclical activity tick up. But whether that translates into improved household confidence, investment confidence, it's going to take more time than that. It's not just about putting more liquidity into the economy, but it's also providing clarity around regulatory policy and being more consistent with policy measures that support or go against the private sector as well. And that's something which institutional and overseas investors have paid attention to, because a large part of the biggest weights in the equity indices there are technology companies, e-commerce companies. And so some of those regulatory measures directly affect the long-term growth outlook for these types of business models.
Mark, you say in your notes that we are expecting to see growing desynchronization of global growth. Where do you see the upside to come from in 2024?
What we mean by desynchronization of global growth is that there's going to be a widening dispersion of economic outcomes for different economies. Those types of economies that will fare better will be those that are typically net exporters of commodities or energy commodities. In addition to that as well, those economies that have strong domestic drivers of growth, secular stories. So within an Asia context, we point to economies and markets such as Indonesia and India. I think that's relatively well understood by markets, but we still see the runway of growth for those types of markets, both on the equities and on the fixed income side, as being broadly constructive.
When it comes to the U.S., we saw really fluctuating data, right? Whether it's that harder than expected CPI numbers, also disappointing PPI numbers, it's been a little bit of a mixed bag. What does that mean for the markets in Asia, especially perhaps when it comes to the credit market, and how that affects your view on duration as well?
Yeah, I think what you pointed out was that we saw a modest upside surprise to CPI, both reported and core in the US, but PPI surprised to the downside. One relatively straightforward explanation for that is we're seeing a bit of a bifurcation between the services economy, which is driving CPI a bit more, and the manufacturing side of the economy, which is more PPI leaning. And therefore, if we translate that into US monetary policy, it's quite conceivable that over the coming weeks, Fed officials try to say to the market, don't be too premature or pricing in aggressive and quick cuts at the start of this year. It's likely that there will be cuts, but they might be more from the middle of this year onwards. And so what that means for Asian equity markets, particularly those open economies that are effectively importing a US monetary policy, you might see a bit of short-term volatility on currencies and local rates to reflect the fact that you're also seeing a bit of a stronger dollar and a bit of volatility creeping back into US Treasury markets again.
Yeah, tell us a little bit more about that dynamic, especially in the bond space, because we have seen long duration bonds underperforming short-term notes when it comes to Asia and Southeast Asia as well. Tell us about how that dynamic and that U.S. data and sentiment towards potential Fed rate cuts this year is feeding into that.
You know, one of the reasons why the long end of the US bond market is starting to rise faster, you're seeing a bit of a steepening of the curve, particularly at the 5-year, 30-year spread segment. It's because the market's perception is that this year we're going to have easing monetary policy and probably quite supportive fiscal policy, given that it's an election year. And we just had some spending package agreements within the caucus of US Congress recently as well. And that effectively leads to a slightly better optimism about the long-term economic outlook for the US, hence a steepening of the curve. That would tend to benefit those businesses which borrow at the short end and lend at the longer end. And so the financial sector might benefit from that. But at the same time, you don't want that steepening to be too aggressive because ultimately borrowers are more sensitive to the longer end, particularly in housing. And that is still a critical part of the US economy and other economies as well.
In the meantime, the Bank of Japan is doing its own thing. How are you expecting their monetary policy to affect equity markets and credit markets in 2024?
We do anticipate that at some point this year there will be some kind of adjustment at the margin to the Bank of Japan's monetary policy stance, both in terms of the policy rates, but also potentially yield curve control as well. But the government, the finance ministry, has been increasingly vocal about the importance of wage growth rising in Japan, which they believe will be a key towards sustainable CPI at or above 2%. They're not there yet. We have the spring wage negotiations, and so we will see that adjustment, but it's not going to come at next week's policy meeting by the Bank of Japan. How this impacts global bond markets? Well, I think that the Bank of Japan is very concerned about any disruption to not only the JGB market, where there's already a high degree of concentration of ownership, but also if the Bank of Japan tightens too rapidly, that will also impact global bond markets, given that the major financial institutions in Japan are big owners and buyers of global bonds, not just JGBs, but also US Treasuries as well.
Mark Franklin, good to have you with us. Senior Portfolio Manager of Asia Asset Allocation at Manulife Investment Management. And let's stay in Japan because, Belle, you're taking a look at those chip stocks.
Yeah, because these are actually really the ones that are moving the most so far. Look at Japan Electronic Materials, for instance, up more than 5%, Advantest as well. So some of the big chip-linked names. Now, there could be a couple of different factors for this. Firstly, it's a good day for Japanese equities. You've got a weaker yen coming through, so that does help the exporting names. So overall, the markets are higher in Japan for another session. There's also the other factor as well. Overnight, we saw AMD, Advanced Micro Devices. Those shares rose nearly 7% or 8% on Tuesday. So that chip maker hit its highest level since December of 2021. On a Barclays upgrade, they've raised the price target on the stock to $200 from $120 instead. So they're very optimistic on AI, driving the growth story there. So perhaps one of the other reasons we're seeing chip stocks gain so much in the session at the open here. Let's change on, because another sector we're focusing in on is the energy moves. Mostly the markets are fairly muted so far in Asia, aside from Japan chip stocks, but it is that slight move to the downside for energy-linked names so far in Japan and Korea. WTI trading lower for a second straight session. So it's the risk-off sentiment overall that's weighing higher yields, higher dollar or firmer dollar also playing into the dynamic, which is also perhaps showing up that risk-off tone or tolerance in some of the earnings that we've seen so far. Hugo Boss is one of them, because the EBIT for the company, this is the high-end clothing maker that's listed in Germany, really disappointing, and so we saw that stock sliding as much as 13%, but the worst session we've seen for Hugo Boss, that's the last close there, of course, since March of 2020. So some of the luxury-linked names, but so far some mixed moves today. Overall, Heidi, we are, as I said, quite subdued in the session.
Belle there with the latest on those moves and really that risk aversion creeping back into markets. Now, we do have much more to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. Wall Street heads are finally calling the bottom on a deal-making drought that's plagued their earnings for the past 2 years. The optimism comes as Goldman Sachs and Morgan Stanley reported results. Bloomberg's Sue Keenan joins us now with the latest. And Sue, of course, were mixed results, but Goldman Sachs at least top profit estimates.
It did have some decent beats on areas that investors really wanted to see beats on. And for example, equities, sales, and trading revenue was triple expectations. And this is a meaningful beat because it certainly beat JP Morgan, a major competitor, by a landslide. You're seeing the difference between Morgan Stanley and Goldman Sachs because Goldman had a different reaction in the outlook it gave. We'll get to that in just a moment. But the asset and wealth division of Goldman Sachs also helped drive gains, posting its highest quarter revenue in 2 years on a gain tied to the sale of a financial management business that helped counter counter a few weak spots. Its fixed income trading results and investment banking underwriting fees fell short of expectations. Asset and wealth management, however, actually did okay. They're on track to meet their targets. CEO David Solomon said, quote, "This was a year of execution for Goldman. With everything we achieved in 2023, he said, coupled with our clear and simplified strategy, we have a much stronger platform for 2024. Analysts called the results decent and relatively solid. The bank, of course, more reliant than other banks on deal making, which remains depressed. However, there was talk of some optimism that we'll see more deals going forward.
Morgan Stanley, in the meantime, warning of lower margins across its wealth unit.
Yeah, and that set up new incoming CEO Ted Pick for a rather skeptical reception, as this earnings call was one of the first handing of the reins. He takes over for James Gorman, who's now moving on, all of that effective in January. The bank warning of lower margins in the wealth unit, and investors are now turning their attention to the firm's ability to meet its goals and expanding its wealth business. Shares dropped the most in 3 months as its trading revenue fell short. It did beat on overall revenue, but missed on both equity and fixed income trading. Goldman Sachs, of course, coming in ahead of them again on equity trading. They also beat on investment banking, with advisory and debt underwriting doing better than expected. And they beat on wealth management revenues, but the pre-tax margin came in below expectations. It's something they're watching closely. And again, it's something they are issuing a warning on. Ted Pick said, quote, "The wealth business is actually in my blood." He said this will be the engine for further Morgan Stanley growth. The shares down again, almost the most in 3 months at one point.
Bloomberg Sue Keenan there with the latest on the banks. And let's take a look at some of the other corporate stories that we're following. Spirit Airlines shares losing almost half of their value after a US federal judge blocked JetBlue's $3.8 billion takeover. The court ruled that the combination would stifle competition, and the ruling follows a trial in November where government lawyers argued that the merger would eliminate a key incentive for bigger airlines to offer budget-friendly fares. Uniqlo is suing Shein, accusing the Chinese fast fashion retailer of copying its popular round mini shoulder bag. Uniqlo parent Fast Retailing says Shein operators must immediately cease sales of imitation products and compensate for damages. It is the latest established retailer to sue Shein following rival H&M's lawsuit in Hong Kong last year over alleged copyright infringement. More to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. The top geopolitical stories that we're following today. Another commercial ship has reportedly been hit by a missile in the Red Sea, the second in 24 hours. Embry Analytics says a Greek-owned bulk carrier was hit about 122 kilometers northwest of Al Salif in Yemen. Meanwhile, the U.S. says its forces destroyed 4 Houthi anti-ship ballistic missiles in drone strikes on Tuesday. And Shell reportedly says it's halting oil tanker transits through the Red Sea. U.S. lawmakers are proposing a new tax deal with Taiwan, the risks angering Beijing. The measure would reduce withholding taxes on qualified Taiwanese residents doing business in the U.S. The agreement will fall short of a formal treaty, though, as the U.S. does not recognize Taiwan as a sovereign nation. Beijing is sensitive to any moves by Washington it perceives as supporting an independent Taiwan. Ukrainian President Volodymyr Zelensky is calling for more international aid and investment in the face of the ongoing conflict with Russia. Speaking with global and financial leaders in Davos, Zelensky called Vladimir Putin a predator and said strengthening Kiev would, quote, strengthen your security. In a bid to boost financial support for Ukraine, he also met with JP Morgan's Jamie Dimon, Blackstone boss Steve Schwarzman, and Bridgewater founder Ray Dalio. NATO Secretary General Jens Stoltenberg says the U.S. will stay in the military alliance regardless of this year's elections and threats by Donald Trump to exit. He spoke to Bloomberg in Davos, detailing the group's spending hikes over the past decade and the importance of keeping up support for Ukraine.
Well, the good news now is that allies are investing more over the last few years. We have seen.
So do you think this was a wake-up call?
Absolutely. So first of all, we made an important decision in 2014 when Russia went into Ukraine the first time and annexed Crimea and took parts of East Donbass. Then we actually agreed in NATO to start to increase our defense spending. And since 2014, allies have increased defense spending substantially. But after the full-fledged invasion in 2022, of course, they started to do even more. And the result is that now more and more allies are spending 2% of GDP or even more on defense. We have in total added 450 billion extra US dollars for the defense across Europe and Canada. And they are investing in advanced weapon systems, F-35s, air defense systems, both to protect NATO territory, but also to be able to continue to provide supplies to Ukraine.
So what is the ask specifically from Zelensky?
His ask is to get more weapons and more sustainment of those weapons. So this is about deploying new batteries, air defense batteries, artillery, and so on. But this war is now becoming a war of attrition, meaning that it's not only about deploying new systems, but also ensuring that we have enough ammunition, that we have enough spare parts and maintenance. And allies are doing exactly that. We're also working with the Ukrainian defense industry to help to increase production inside Ukraine. So yes, it's a huge task. We should not underestimate Russia in any way, but we have to remember where this started. When the full-fledged invasion happened in February, most experts believed that Putin was going to take control of Kyiv within days and Ukraine within weeks. That didn't happen. The Ukrainians have liberated roughly 50% of the territory that Russia occupied in the beginning.
The feeling in Washington is this last supplemental aid will be the last one. We're going into an election year. It's a deeply divided political situation. What happens then looking into 2025? How can Ukraine sustain itself without the backing of the United States?
Wars are by nature unpredictable, and no one can say exactly how this war will end or when it will end. But what we do know is that we cannot allow President Putin to win.
NATO Secretary General Jens Stoltenberg there, speaking with Bloomberg's Anne-Marie Hordern. Take a look at our futures in Europe are opening up at the moment. It is quite a bit of downside there. The risk aversion really petering through to another day. We did see European stocks already sliding for 2 straight sessions on the back of higher bond yields, fresh doubts over the timing, the scope of interest rate cuts from not just the Fed, but of course more regionally relevant what the ECB does as well. Data this week really kind of underscoring how fragile the euro area economy has been. But still, bond yields rose after we heard from one ECB Governing Council member about his prospect for delayed rate cuts. This is Bloomberg.
Right, we are waiting for the non-oil domestic export numbers out of Singapore. It's supposed to drop at the bottom of the hour for the month of December. We're still not getting those lines, but this, of course, coming after we actually saw exports growth returning to Singapore for the month of November for the first time in more than a year. We'll continue to watch for those numbers, although we're not getting them at this point. But, Belle, tell us what's happening in the markets, because it still seems a little bit of a mixed picture.
See a clear outperformance of Japan versus what else is happening in the market today, because if you take a look at the GMM here, you can see a fair bit of red across the screen so far this morning. What's really standing out to us so far are the moves that we have in bond yields, because we've got the Treasury 10-year there continuing to hold above that 4% mark. We had the Fed Governor Chris Waller overnight really moving the markets, because he says that we're not going to see any sort of rate cuts from the Fed, or he's arguing the case for no rate cuts until inflation is very much in the rearview mirror, so possibly toward the end of this year, but pushing back on those expectations of 6 cuts from traders in 2024. So bond yields are moving higher. When you have that sort of scenario, of course, it puts pressure or upward pressure on the dollar. So you do see a lot of currencies here as well moving to the downside so far. Again, that puts pressure on equities. So unsurprising, you're seeing the Kospi, for instance, flipping yet again into negative territory, down more than 1% at this stage. The standout, as you can see here, is very much Japanese equities so far. You've got the Nikkei trading up 1.3%. And one of the dynamics playing into that is, again, that currency weakness, because the Japanese yen around its 100-day moving average, but down 0.2% against the dollar so far this morning. That is really helping, as you can see, Japanese equities, exporting names. But we're also tracking another sector in particular today that is really prompting those gains. Let's change on. Take a look at Japanese chip makers. We had AMD, for instance, a price target upgrade from Barclays overnight. That led to the stock jumping. You've as well got that optimism around Japanese equities generally. Japan benefiting from corporate governance reforms. It's benefiting from geopolitical tensions, and so it is moving to the upside as Heidi, investors just continue to divest away from Chinese equities, and part of that comes down to the economic outlook.
So much of it comes down to the economic outlook, right, Belle? We'll be getting the latest domestic activity number, retail sales, fixed asset investment, industrial production, also the 2023 GDP numbers in less than 2 hours today. Earlier at Davos, Chinese Premier Li Qiang said that the economy grew around 5.2% last year, surpassing Beijing's target. Take a quick look at some of the broader forecasts from global banks in terms of expectations for this year's domestic activity growth. We're seeing highs of just shy of 5%. The sort of most bearish expectations coming from the likes of ANZ and Morgan Stanley at just over 4% there. Our next guest has been expecting slightly better growth of 5.3%. Michelle Lam, for a greater China economist at Societe Generale, joins us from Hong Kong, and that is for 2023. Of course, Michelle, beyond the headline number, which is sort of never, I guess, that compelling, if you lift the hood, what are you looking for in terms of the domestic activity indicators, and if they potentially tell us that the worst is behind the Chinese economy?
Well, first of all, we already know that the 2023 growth number is 5.2%, and which means the year-on-year growth for the fourth quarter, I think, is likely to be somewhere around 5 to 5.2%, which means that on a quarter-on-quarter basis, there's probably some moderation compared to the third quarter. But that's understandable because in the second quarter, we have a big deterioration. But overall, I think it tells us that the second half of last year, the growth momentum has been stabilizing after the deterioration in the second quarter. And what I will be looking for is whether there's continued some sluggish momentum in the retail sales, because we do know that the consumer confidence has been deteriorating because of the house price correction. And I think that's really what I will be focusing on.
Michelle, the bigger kind of existential issues, right, was going with the property sector, whether they can deleverage that bubble, you know, in a steady way that doesn't cause further shocks to the broader economy. Are you confident that that can be played out?
This is our base case, but I think there's still downside risk to the situation, because if you look at the house price data from the national statistics or even from the other data providers, it does show that the house price momentum has been falling in the fourth quarter, and that's after the easing measures that were announced by the PBOC to lower the mortgage interest rates, to lower the down payment ratios. So I think the concern here is that if the house prices continue to fall, that could further deter the home purchasers' willingness to buy the property sales, and that could further deteriorate, little deterioration in the developers' sales revenue and the funding conditions. And I think this is somewhat a downside risk that is starting to building, but I think policymakers are also, there are still a lot of policy room that the policymakers can do. For example, we've seen the announcement of the whitelist of 50 property developers towards the end of the last year. I think this will be, if it is being implemented, this could put an effective backstop to ease the concerns of the home buyers over the private developers.
The 1 trillion yuan sale of special sovereign bonds that we've also heard about. In your mind, does this signify meaningful fiscal support? Is it still more targeted? Because pretty much every investor that we speak to at the moment is still on the sidelines when it comes to Chinese risk assets until they see what they call meaningful stimulus.
Yes, I think, well, first of all, on the fiscal stimulus, we really have to look at the overall package put out by the government, because essentially there is the on-budget fiscal deficit numbers, which is been raised to 3.8% of GDP last year, and also the amount of special local government bonds, and then adding to any potential announcement from the government on the CGBs, as speculated by markets yesterday. So overall, we will need to wait until the March MPC to see the overall fiscal numbers. But I think it does signal that the government is willing to step up the policy support if there is further deterioration in growth. And I think it's also need to put into the context to what kind of the growth target we will have for 2024, which I think is likely to be around 5%.
How do you lift confidence, Michelle? Because I think that's one of the main kind of head scratches at the moment, both for households, consumers, and businesses in China. If we're in the middle of a deflationary, demand side downward cycle or spiral, I should say, how do you improve that outlook?
Well, it is actually not very easy to lift confidence right now, because what China is facing is structural problems, which there has been too much debt because of overinvestments either in infrastructure or in the property sector. And there have also been some rounds of crackdowns to the private sectors that is still really derailing the confidence. It really takes time for this confidence to come back. And on the upside, we are really seeing the policymakers are trying very hard to announce some policy measures to support the private sector. But I think at the end of the day, first of all, I think as a short-term measure, it will be pleasant to see that there are more stimulus coming through from policymakers, such as the monetary easing funds, and as we see the extension of the MLF, for example, and also the step up in the PSL lending last December, and also the fiscal stimulus, which we already have the announcement from the possible announcement from the policymakers that the 1 trillion CGB could be coming up. But I think at the end of the day, we still really need to solve the problem of the property sector, which is, I think, to essentially speed up the debt restructuring of the property developers to make sure that the home buyers who want to upgrade, or if there's any kind of structural demand, they are not concerned about the developers not being able to hand over the project. So I think supporting the fundings to selected developers will be key here.
Michelle Lambert, Greater China economist at Societe Generale, there with us. Really great to have your insights. Of course, as we get into the next couple of hours, we will get those domestic activity indicators and the final GDP numbers as well for 2023 from China. Let's take a look at how all of this is playing into the market opens. Our Asia equities reporter Charlotte Yang joins us now from Hong Kong. So we've got the 1 trillion yuan worth of special sovereign bonds to contend with. Xi Jinping also wants a stronger yuan and digesting all of the data that we're expected to get as well. Is any of this likely to meaningfully change sentiment when it comes to how Chinese markets are trading?
I think that might be a bit difficult. If we look at, the Nasdaq Golden Dragon Index, which is a gauge that tracks Chinese companies listed in the U.S., the gauge is down 3.8%, and that's the biggest drop in 4 months. Well, some of that is playing catch-up because the U.S. markets was closed for Monday, but still you can see that investors are not, I think they're not pricing, too much of a meaningful upside surprise from the the data dump we're going to get today. And, with the GDP figure, the fourth quarter, investors are likely just to look past that, given the year-over-year base effect that last year the fourth quarter was the fourth quarter in 2022 was still very much had the impact affected by the pandemic, and they're a lot more likely to focus on December activity data, and whether it was industrial or like retail sales or property sales. I think investors still pretty cautious, given a lot of the high frequency data they got points that month over month the momentum for the economic activities are still struggling.
Will valuations, though, make a difference? Because when you're investing in markets, you're always thinking, is it still relatively cheaper or better than other economies?
I think for valuation-wise, it's very cheap if you look across the space. And for some of the really pretty good, I would say, companies, especially in the internet space, with strong fundamentals and valuations, definitely, I think the strongest argument for Chinese bullish investors still, China bulls that are still clinging on to this. But with that said, we haven't been able to see, valuations driving any meaningful flow back into this market. I think we still need more patience to see, the broader economic situation getting better, and especially with deflationary, which is one big risk investors are parsing now, as we have seen, across different sectors with EVs, consumers, and internet companies have been engaging in this intense pricing competition to win over consumer demand, and that's a big headwind investors see for company earnings.
Our Asia Equities reporter Charlotte Yang there. And we're finally getting those non-oil domestic export numbers out of Singapore, which we were expecting at the bottom of the hour. But finally, for the month of December, is a contraction of 1.5%, which is very disappointing to economists' forecasts, which were expected for growth of 1%. Also, given that Singapore's exports had finally returned to growth for the first time in more than a year in November, we're again seeing it contract 1.5% for the month of December. Month on month, those numbers have been more volatile. And again, this is disappointing economists' expectations. And it's also a contraction of 2.8%. Electronic exports year on year, the contraction has eased a little bit from the previous month, but it's still in the negative 11.7% contraction for the month of December. So this is a little bit disappointing to economists' expectations, but perhaps not terribly surprising, because when we saw those growth numbers return for the previous month, it was really mainly to do because of a low base. And we know that global electronics demand continues to be sluggish, and we're seeing again more examples of that with Singapore's non-oil domestic exports surprising to the downside. This is Bloomberg. Take a look at how Japanese assets are trading early in the session. We're seeing the Nikkei and the Topix gain more than 1%. When it comes to the Nikkei, it's the best day since January 12th, and we're seeing it rebound from losses in the previous session. The Japanese yen continues to weaken against the U.S. dollar. Not surprising, given that the Bloomberg Dollar Index had the best day since March on those rising Treasury yields. We're seeing the Japanese yen holding at that 147 level. And of course, we've been watching those yields in JGBs, given the rise in Treasury yields here. We saw the 10-year yield in the U.S. top 4%. Now, of course, all eyes on what the Bank of Japan will do next. And with the Bank of Japan expected to unwind a decade of monetary easing this year at some point, it's suddenly exciting to be a trader in Japan again. Brokerages are staffing up, often seeking out veterans who can remember when Japan last had positive rates. Senior FX and rates reporter Ruth Carson joins us now with more. So Ruth, tell us more about what, or rather who, is becoming the hottest commodities in Tokyo right now.
Absolutely. Japan markets are booming. There's no way to look around that. Topix at 34-year high, dollar yen at 147, JGB yields, touching nearly 1%. And as a result, banks, fund managers, brokerages, they're all looking to beef up their ranks. But there's a snag. The last time Japan actually experienced positive interest rates was in the 1990s. So trying to find people, this hot commodity, traders, investors who've traded through this period is hard. These people have retired. Some of them are no longer working or in different countries. So banks and companies are just doing all they can, throwing so much weight into hiring and training people to get back on this train of what inflation means for Japan markets.
Ruth, what are some of the examples of the companies or traders that are really looking to make the absolute most of rising interest in Japan at the moment?
Absolutely. There's plenty of examples, Heidi, and our reporting shows that. I mean, just to name a few, Ken Griffin's Citadel, for instance, is looking to set up a Tokyo office, and they shut down there 10 years ago, you know. Sean feels the same. We've got examples of Concordia, which is a regional lender, for example, really beefing up their training programs for traders and employees. And even outside of Japan, there's plenty of examples. 2 JP Morgan ex-traders in rates for Japan have set up a hedge fund called Brahman Capital in Singapore to cash in on this. They're looking to trade JGB. So it's all super exciting. All eyes are on Japan.
So do those veteran traders have any advice to the young ones as they have their first true taste of inflation?
I think a lot of people have plenty of things to say, but I'll give a couple of examples. Yasu Masanishi, who is the former markets head for Mizuho in Japan, has this advice for people. He likens the current conditions to that of a typhoon. You know it's coming, but you don't know how hard it's going to hit or when. So be prepared. Another example is Mr. Yen, as he's professionally known, Aisuke Sakakibara. When I spoke with him, he said it's incredibly hard to draw parallels even with the 1990s or 1980s. So people just have to be incredibly flexible and just be prepared for the unknown. And that's the best way to go about it.
Read Bloomberg. It's the best way to be prepared, right? Our senior FX and rates reporter Ruth Carson there with today's big take on the Bloomberg terminal. You can find that at bloomberg.com as well. Plenty more to come. This is Bloomberg.
AI is a brilliant tool for people to be more productive. Now, it means the bad guys will be more productive, so they can do more cyber attacks, so they can design weapons. You've got to make sure the best AI for cyber defense or measures to defend against bioterrorism are in the hand of the good guys. And it's a challenge, but people sometimes lose sight of the fact that this is the biggest productivity advance in our lifetimes.
Bill Gates speaking there about AI at the World Economic Forum meeting in Davos. Shares of Indian software giants have started the new year on a high after better than expected sales. Last quarter surprised investors. At Davos, we spoke with Wipro's executive chair, Rishad Premji, and asked him whether that momentum can continue.
It's been a tough year last year for the tech services industry. The good news is I find, and I'm hopeful, that 24 will be a better year than 23. And we've just announced results last week. We were at the top end of our guidance compared to what we thought. So we saw some decent in-quarter execution basis what we saw from customers as well. But a couple of things that give me some comfort, right? One is just the conversations with customers and how they're thinking about their tech spend for 24. The other is just the way our consulting business is starting to see some uptick, right? And if I look at Capco, which is a large consulting organization that we bought a few years ago, they've seen double-digit order booking growth last quarter. To me, that's an important early green shoot indication of perhaps where spends can go. Having said that, I'm still cautiously optimistic. I'm watching it closely, but I am hopeful that 24 could look perhaps better than 23.
You talked about having some comfort. What are the risks out there? What's keeping you up at night?
No, I mean, certainly the environment is a difficult environment. We certainly have a fragile economy out there. I think the US is looking a little bit better. As we speak, Europe, for me, is still quite uncertain. You have a large chunk of the world going into elections, and that creates its own uncertainty.
Including
as
India.
You come out, including India. You have just the environment with the geopolitical situation, a conflict situation with wars. And then you have just the whole world being disrupted with AI and what happens with AI governance, and how do you think about having just structure and transparency and safety from an AI perspective as well. So there are lots of uncertain elements out there. The comforting fact is some of these also become opportunities. For us, certainly if you look at AI and how customers think about it, can be a huge opportunity as you move forward. If I look at what happened last year with AI, we had about 80 to 100 POCs where customers were experimenting. And I find more and more customers are really thinking about real business impact as they go into 24. So that can be the opportunity and the plus side as we move into an environment that's a little bit more favorable generally as well.
You talk about opportunities in AI. Realistically, when can AI be a key revenue stream for you or other Indian IT companies?
Yeah, I think it is becoming all-pervasive on two fronts, Hasinda. One, I think for organizations itself, we are disrupting ourselves with AI. We've just committed to sort of infuse AI in everything that we do. And I'll give you a very simple example. We've completely transformed the way we serve our own employees, leveraging AI. Today, I can go into a chatbot and apply for my own leave, ask for my own sort of Form 16, my tax forms, without having to engage with my assistant or anybody else in the office, without having to sort of click through 7, 8, 9, 10 screens. And we are seeing tremendous number of use cases built from an experience standpoint for employees. We're seeing dramatic change in how we are generating content for our marketing efforts. We're seeing tremendous traction in how we're generating sales material. How can we have our first RFI responses completely generated through systems? So there's a tremendous amount of disruption happening internally within the organization. And then customers, as I said, are very serious about moving from experimentation to real business impact. And I expect that only to pick up with time as we move into 24.
Wipro Executive Chair Rishad Premji speaking with Bloomberg's Hasinda Amin in Davos. Take a look at what futures are doing at the moment as we have about an hour to go for China GDP and activity data. We're seeing some downside across the board. Bloomberg Markets China Open is next. This is Bloomberg.